Welcome to the Great Reset Opportunity Report. I'm Chris Blasi. I'm very pleased to have a guest today who is a true expert regarding central banks. Now, central banks produce the money that is basically the bedrock and the foundation of every economy around the world and the grease for the skids of global commerce. Her name is Nomi Prins, and I'm sure you know her, but I just want to give you a little bit about her great background. Nomi's a renowned journalist, a former investment banker, an author, and a speaker. When she came from Wall Street, or her years there, she had 2 stints as managing director at both Goldman Sachs and Bear Stearns. She also served as a strategist at Lehman Brothers and an analyst at Chase Bank. Nomi's become a prolific author, and she's penned such excellent books as It Takes a Pillage, All the President's Bankers, and Other People's Money. Her new book is Collusion, How Central Bankers Have Rigged the World. And in it, Nomi explores how the role of central banks have changed and their role or their position in the hierarchy of the global financial and economic system now. So I'm really pleased to have Nomi on, and I'd like to welcome her to the show. Nomi, welcome.
Thank you very much for having me on.
Oh, it's our pleasure, Nomi, and it's a real treat for our viewers and listeners to hear what you have to say. Now, just to start off, we usually kick the show off because we're all about the Great Reset. And from our perspective, there is a Great Reset. And we would define that as the profound changes that we believe are happening in the global financial, economic, social order, and political order. So we'd like to kick off to get a level set of where our guest stands on this phenomenon. And if you can share maybe some of the indicators you would use to either confirm or refute its existence.
Yeah, so we are in a reset transition. I mean, no question about it. And I say transition because it can go one way or the other depending on what happens sort of moving forward. But a couple of things have happened that really create a different platform for the financial markets, the monetary system, and so forth since the financial crisis of 2008. And one is the central banks. And not all the central banks, the major central banks, predominantly of the developed world, and in particular the G3, the Federal Reserve, the European Central Bank, and the Bank of Japan, have what I term colluded, because that is what they did in the wake of the financial crisis and through today, to produce an exorbitant amount of capital through their own mechanisms in a way that was unlimited, in a way that was unregulated, and in a way that's not particularly transparent as to where it went, except ultimately in the asset bubbles that it has produced. And that is different. There's about $14.5 trillion worth of artificial money, of electronically conjured money that has been produced by just those 3 central banks. If you throw in the People's Bank of China, which uses it for different purposes, you're up to $22 trillion worth of subsidies for the financial system, for the markets. And once that is leveraged, i.e. once corporations and governments and countries borrow because rates have been so cheap from the developed world during this period, they create a record amount of debt. And so now what we have is a situation where we have $22 trillion of subsidies that weren't there 10 years ago. We have a record amount of debt. We have a situation where, from a currency perspective, emerging market currencies are devalued more than usual relative to the US dollar in the wake of this situation, and they are hurting. And that has manifested in inequality throughout the world, in economic uncertainty, as well as in financial bubbles.
So let me ask you about here at home, the steps the U.S. Fed is taking with raising interest rates. What do you see? Where are they going to go with this? And what do you think the ramifications? Are they going to continue this? And isn't that going to bring more and more pain on the emerging markets who are, awash in debt? Are they going to have to change course in the near future? So what's your perspective?
Yeah, that's a great question. I mean, I talk about this idea of a catch-22 in my book, Collusion, and then just in articles I've written since, because the Fed basically manifested, along with these other central banks, is the situation. And the exit to this situation would be a reversal. However, an ultimate reversal, if you dump $22 trillion worth of assets back into the markets, you would create an absolute collapse. As a result, what has happened is the Fed has been sort of the first mover in raising interest rates a bit. They started in December 2015 with a 25 basis point hike, which was tiny. They waited an entire year till December 2016 to raise by another 25 basis points. Why? Because the markets completely dumped in the beginning of 2016, not just in the US, but also throughout the world. They kind of took their foot off the hiking gas, and they waited another, through the end of that year, 2016. There were then another 3 hikes in 2017. So far, we've had 3 hikes this year, up to 2%. But other central banks, and this is important, have remained at either 0 or negative in terms of their interest rates. So on average, the world today, even though the Fed has raised rates, is somewhat at 0% interest rates still, the developed world. But what we see now is uncertainty creeping into the markets in terms of debt, in terms of these 500 to 800 point swings in the Dow and so forth. And that's a manifestation of the uncertainty as to whether the Fed's going to continue to hiking, which is, to get back to your question, I personally do not think they're going to hike in December. I did think they were going to hike in September. I don't think they're going to hike in December, and I don't think so because ultimately there is a slowdown in the minimal amount of economic growth that has happened recently. There is a debt overhang. There's a debt overhang in the United States as well. If the Treasury Department has to borrow money at higher rates because rates have risen, that creates a bigger deficit, that creates more political problems in Washington. Not that the Fed supposedly is a political body, but in reality, it lives in Washington. And it watches the markets, and it's really the sort of interim between Washington and Wall Street, regardless of the legislation that created the Fed in 1913 saying that it's independent. So ultimately has to take all of this into account. And there is such a tremendous amount of volatility in the markets right now, in the debt markets, in the stock markets, politically throughout the world, that I think the Fed will have to wait a moment and recalibrate at the end of this year. What happens next year? They forecast 3 to 4 interest rates next year. Powell has said he wants rates ultimately around 3% over the next few years. So he's even changed his language a little bit. So I don't think there's more than like 2 hikes next year. And I think it's really, if that happens, it's done in a manner that allows the markets to sort of calm down in between any of those rate hikes. And I don't think we're going to see hikes from the Bank of Japan. And I don't think we're going to see hikes from the European Central Bank or some of the major central banks in Europe beyond maybe 25 basis points, Bank of England one time, and that's all next year.
Because basically the world can't afford more expensive debt. So we're really teetering right now. So, I want to kind of expand a little bit on something you said before about, central bank, the Fed isn't supposed to be political, but let's be real, right? Where's home? Washington, D.C. And I think a lot of people really don't understand what the Fed is, who they're really serving, right? I think there's so much misinformation, and I think that's been purposely allowed to happen. So as a former insider, right, someone who's really at the highest levels of the biggest, financial firms in the world, Bear Stearns and Goldman Sachs, what could you share with the folks listening so they really understand the relationship between the central banks of the world, the governments of the world, and the big businesses of the world, and who they're really to serve, and what can you shed on that relationship that people should understand?
Yeah, and first of all, just understanding what they say versus looking at what they do is very important. I remember back when I started on Wall Street, we'd play Bet the Greenspan. Alan Greenspan was the head of the Fed at the time, and when things, data came out, he would always have a statement, and the trick would be to figure out how to trade based on his statement. But that was sort of the beginning. But the reality is that banks rely on liquidity. They rely on a certain level of infusion of capital to be there, whether they have an emergency or whether they're just simply doing day-to-day basis. And as a result, the New York Fed, which is in the middle of like downtown Wall Street, and the Fed, which is in the middle of Washington, work together to ensure that that's the case. That is why, in the wake of the financial crisis, rates were put to 0. That's why so many trillions of dollars of money were made available to buy bank assets and government debt so that banks could reevaluate the assets they had left on their balance sheet that the Fed wasn't buying up so they would look better. That's the ultimate relationship. And those moments, those like nighttime Sundays during the financial crisis a decade ago, when you had in a room the senior CEOs of Wall Street, the Treasury Department heads, and the New York Fed head at the time, Tim Geithner, who became the Treasury Secretary, and Obama in a room together, they weren't sitting there really thinking about how is that average person going to deal with like the no interest rate move on their savings account that will happen when we put rates at zero? That is not the conversation they had. The conversation they had was Goldman Sachs and Morgan Stanley were about to fall apart because they had no capital to maintain their day-to-day operations. That's like you're driving on a highway, your car is on empty, and you're like, I don't know if I can get to another gas station before this thing stops in the middle of nowhere at night, and I'm totally screwed. That was the situation they were in. Collectively, the Fed decided, because it could, to provide them liquidity. It's been doing so for 10 years. So even though, going back in time over 100 years ago, the Federal Reserve Act in 1913 created the Fed to supposedly be independent, to provide credit, and this was the argument made to the population, to farmers, to the middle of the country, so that Wall Street couldn't just, sort of take it all for themselves in an emergency and not provide it to the rest of the country. That was the argument. The reality was the United States had come through a panic, had come through a recession, and JP Morgan, who was the head of Morgan Bank, decided that he did not want to float the government anymore. That was a lot of the conversation that went around the creation of the Fed from respect to his bank, other banks, and the government in itself. That's how the Fed was created, and that is who it serves. So the fact that now we have rates so low actually does hurt the average person in a number of different ways. It hurts from the standpoint of a person, a responsible person who wants to save money, getting return on that money in a savings account. Right now, banks, and they're being kind of casting, there's some negativity on this right now, are paying almost nothing for savings accounts. So that's one place where someone can't get it. Pension funds that were supposed to rise with inflation and get more money by investing in government bonds are getting close to very little coming from government bonds. Same thing with life insurance policies. Any long-term situation that a person would have relied upon has really been reduced dramatically from the standpoint of return on their money. So there is a flip side to this. That was not discussed, and that hasn't really been discussed in the time of the financial crisis and in the 10 years since then, because that is not really who the Fed operates for.
Sure. So when the financial crisis came and they took the actions they took to bail out the banks, as you said, without any thought about how it's going to punish, hurt, destroy the small savers, small businesses, right? Small, mid-sized businesses, they're not getting any credit.
Right. That's right.
We seem to be stuck and we can't get out of it. So how long can this continue where, one side, the banks are constantly, taken care of, and the other side is bearing all the brunt and the pain of it? I mean, how sustainable, how much longer in the future can it go? Can it really go on forever? Or is there going to be a point where something's got to give?
Right. Well, it's an excellent question. Like 5 years ago, I would have said it has 2 more years. And 3 years ago, I would have said it has 2 more years and then 1 more year. Because the reality is all of these central banks of the developed countries do not have a limitation as to what they can do. And that's crucial to understanding that they don't have to come up with a real exit plan to what they do, because they can continue to do what they're doing. They can continue to manifest more money. The Fed now can reduce rates if it wants to by the 2% that it raised them if it needs to plenish the financial system, ultimately to plenish the banks, and to reduce the cost of government debt to these developed countries. In the wake of that, of course, the emerging countries, small businesses, as you mentioned, medium-sized businesses, have had a harder time both getting credit and getting credit at the same kind of cheap levels that have been allowed to sort of the upper echelons of the financial system, and that's a problem. So how long can that go on? Well, what we're seeing right now are these, sort of volatile breaks in the market, in the debt market, as well as more visually the stock market, because it just simply moves faster. So this is in and outs happen much more quickly in the stock market. So it's just more of a measure. And that's going to create some pause, and that's going to create loss to some companies. Some companies will not be able to repay their debt if rates go higher, or if they simply default because their businesses themselves weren't able to sustain that amount of debt. There's an abundance of leverage of debt in the world because of that. It's interesting that the head of JP Morgan Chase, for example, Jamie Dimon, said not too long ago that if there is another crisis, that the Fed is going to have to hopefully buy some equities. Now, there's already a lot of buybacks going on throughout the street, including by JP Morgan Chase, allowed by the Fed, and that can keep the market up if the Fed really were to decide to do that. So long-winded way of saying this crisis is going to look, the next one, very different from the last one. The last one was sort of like a massive sort of acute point in time where all of the debt, all of the credit kind of collapsed around the same time. All the leverage basically stopped. And that's why central banks replenished it. Now what's going to happen is we're going to see like little sort of pokes above this debt carpet along the way, and major declines in the stock market along the way to something that will not feel as much like a crisis, but ultimately will get to that point. So I think over the next couple of years, we're going to see that. We're going to see more lows in the market that happen sharply in sort of a day's business, and then we're going to see it pop back up because the Fed's going to take its foot off the rate hikes, or another central bank is going to buy more assets, and they're going to keep doing what they're doing and just sort of push the problem into the future. The unfortunate thing is that real growth in the economies, which all these central banks promised they would produce by this injection of money, has not really happened. Even in the US, we're getting some figures out this week, but we had 4.2% growth last quarter, but that's predominantly on the back of export-related sort of plays in soybeans and other things because of trade tariffs. So it's not like this has really stimulated the economies. If the economies figure out a way to use the small amounts of capital they do have to grow themselves and to have foundational growth and sustain themselves and produce money for small businesses and middle businesses, then we have a chance of just having the crisis avoided, but a big crisis avoided, but sort of mini drops along the way anyway.
Mm-hmm. So your book, Collusion, this is a huge topic that we're discussing here, and can you tell us a little bit about the book? I believe it really gives the data behind the statements about how the central bank has changed and shifted in its role since post-2008. So why don't you just tell us a little bit more about it?
Sure. So it came out of I had been asked to speak at the Federal Reserve. They do this annual meeting, the Fed, the IMF, and the World Bank in Washington. It's sort of an off-record meeting where all sort of leaders of those banks get together and talk about their problems. And I was asked to talk about why Main Street wasn't being helped by Wall Street back in middle 2015. And I said, well, because you never made them. You created all this money. You gave it to Wall Street. You never had any strings attached to it. Why would you expect it to go into Main Street to a real extent? And that kind of got me thinking, because I was in a room at the Fed with all of these central bankers from around the world, not just the major countries, but a lot of the smaller countries as well. And they're sitting there nodding their heads saying, yeah, this is exactly right. And plus the US and the bigger banks are producing all this money. We can't do that without creating inflation. They can, we're screwed, etc. And out of that came this book, Collusion. And what I did was I decided to, and this is how I just do research for almost, like I go to places. I don't really sit back, sort of and do it all on a computer or just through other people's research. I go out. And I decided to go around the world, and I picked countries and regions for the book that indicated where things were going to get much worse because there was no collusion with the Fed, and where collusion with the Fed created a certain, aura on that perspective. So I went to Mexico, to Brazil, to China, to Japan, throughout Europe, and so forth. And in each of these places, I kind of cataloged what happened over the last 10 years. What has the Fed done? What did they say happened? What actually happened? All from public records. And I put it together in these sort of geographical timelines. So to create, sort of going back to the scene of the crime, right, the financial crisis of 2008, out through today, throughout the world. And that's really how I'm piecing together what we're talking about from that on-the-ground research where, some countries like Mexico and Brazil have had major shifts in their governments and their economies and trying to keep up with the Fed and not being able to keep up with the Fed and so forth. Whereas areas like, sort of Japan have just sort of maintained this coordinated, collusive effort with the Fed, and as a result, they have low growth, but they haven't had, although recently markets are going down, a tremendous crisis. And so I really looked at how that was all happening, and really the dialogue, the chatter that was going on amongst the major central banks, what they were saying about each other to their own press versus what they were saying to each other, and put a story, really, I think, of the last decade that just wasn't out there. It's a complicated story, but the main thing is the big guys, created money. The smaller guys tried to keep up, and we are where we are.
Nomi, this is what I think really differentiates your works from a lot of other people. You talk about traveling the world instead of just, sitting back at home, reading everyone else's works and kind of rehashing it. So we all know when you get outside of your home base, and it's a lot different. You learn a lot more, which is going to kind of take me around to the next thing I want to ask you, right? You travel constantly. I know recently you're in Mexico. You're talking about risks to the global economy. Now, in these travels, you're talking to the people that come to hear you speak. You're talking with other speakers. Other people recognize experts. political leaders, financial leaders. What is their opinion of the assessment of the health, stability, and fragility of the global economy and the global financial system?
Yeah, I think getting down to in those talks and in those conversations, there is fear, there is concern. And again, that's manifested by the actual volatility in the markets that we're starting to see more and more. There is real debt, particularly in emerging markets. There is a concern that capital that came in when it was more readily available and when there wasn't as much of a concern about growth or debt is going out very quickly. And as a result, there's concern that there won't be enough money there to sort of produce the kinds of real long-term infrastructure or sort of major economic development that was planned upon when it was coming in. And that causes these governments to think, okay, do we need to take on more debt to like fill out the last, the projects that we can't do now because capital is flowing out. And there is concern. There's also concern at the major levels. The IMF has come out with, and I've spoken to a lot of people at the IMF along these years with reports saying, look, 59% of the buying power in the world, the purchasing power in the world is coming from emerging markets. That's a big percentage to go down. It was 43% before the financial crisis. So there's a lot of potential problems out there, and I think there is a concern. There's recently a concern about trade tariffs and how they will manifest in different economies throughout the world as well. With respect to Mexico, there was a little calmness over the fact that there's been an agreement recently between the U.S., Canada, and Mexico. But there's also a concern as to whether that agreement will ultimately not be hampered by tariffs or by other sorts of geopolitical decisions. So what I'm seeing right now is a lot more uncertainty in the world. And I have this slide that I showed in Mexico at a couple of my talks, which is a divergence slide. And it shows that just most recently, even though in the last couple of weeks it's changed a bit, but the U.S. market has gone up, and other markets, the sort of average of world other economies has gone down in the last year and a half, and it's very dramatic. I mean, it's literally like I'm showing you. It's that sign, and that's a problem because that's real money. That's also not just speculative money coming out of these economies. So I'm feeling a lot of concern on the plus side because I always like to figure out where the good stuff is. I have had a lot of talks about where money needs to really go this time. If we can have a reset. And that is into growth and infrastructure and research and development and real jobs and things that are sustainable that actually help foundations of all countries. And I'm hearing that there's a lot of more planning to try and do that from now in order to have sustainable growth as opposed to just sort of, growth on paper that's, moved about by debt or by stock prices.
Is that fair to say, you hear the criticism that the U.S. has become too much of a financialized economy, not real things, right? Isn't that it? We need to move the needle a little more to being a real economy, producing real things, as opposed to the machinations of Wall Street, right? Driving stock prices based on manipulation and, shuffling things around in a high level layman's terms.
No, that's exactly right. And I have those conversations not just, throughout the world, but in Washington. I was there a couple of weeks ago. I'll be there in a little bit. I think it's important to think about, plans for growth and to look at infrastructure, whatever it is, development from a standpoint of it being a real investment as opposed to simply a cost. And I think that, ultimately it takes money to like build a railway or a bridge or a water plant or, whatever it might be. But that also creates jobs and that also creates a stronger economy and sort of potentially a shift in how people buy things and where they are and where they move and everything else, which is more dynamic than simply looking at money going into a stock market.
Sure. So, we talk about this show as the opportunity report, right? And what that infers is that with change, there's opportunity. Now, I think some of the change and some of the reset can be so dramatic and powerful. Like you look at 2008, there weren't many refuge for the average person. So I don't mean to put you on the spot, but if there's anything you can share, I'd like to first, I'm going to read a quote so I get it right. Because I think it kind of paints a picture that we're really on a precipice, right? In the sense, I guess it could work out what the central banks are doing, but if it doesn't, there's no plan B. And I don't want to take away, and I'm going to jump into the quote, and then I just have a follow-up question. You stated that we have arrived at a new, unstable normal. There's no hard stop, no external force or organization to dial back the artificial lubrication of the banking system and financial markets. And you said the issue isn't whether this money conjuring game can continue. It is that central banks have no plan B in the event of another crisis. So two things, two parts to my question. What is the probability that we're going to go into another financial crisis of equal or greater magnitude than 2008? And there's a lot of beliefs out there that if we do, who's going to really bail out, what needs to be bailed out? And if we do enter into another crisis like that, understanding that there's very few places for the average investor to kind of run and safeguard what they have, is there any recommendation or, idea of what they should kind of get into prior, move their assets into prior to such an event?
Yeah, so I definitely think there will be another financial crisis. It might not look like the last one, as I said. It could be in little bits and pieces, and it could aggregate into something of a large magnitude. And I believe that magnitude will be greater than the magnitude of last financial crisis, and that is because we are falling from a higher height. So all the subsidy, all of this Fed money that has gone into the markets and has gone into sort of puffing them up into, artificially, now kind of has them. It's like a higher point along the mountain. So if you actually are coming down, you're coming down from a much greater place, and that's going to create ultimately a lot more loss. Now, as I said before, central banks can continue to play the game that they are already playing because they do not, as you read my quote, have an exit strategy. They don't have a plan B. All they have is like doing more of the same and sort of calibrating it along the way. They'll continue to do that because no central bank leader wants a financial crisis on their watch. They'd much rather say, I did a great job. It's on to the next guy or next gal. In terms of how, you protect yourself for that, I can tell you, what I do, because I think that, and this has helped me actually even leaving Wall Street and sort of going into this other realm of my life. I had always thought it was important to protect what I had and try and build some along the way, not take crazy risks and understand when market forces change, how to, not be caught in that sort of world. I at the moment have a lot of money out of the market. And what I do is when I do go into the market, when I do invest in anything, I invest in the least leveraged companies. I invest in companies that are not in the fray of trade wars to a large extent. And I invest in companies outside of the financial sector for the most part. Now, there can be times along the way where it's like an earnings numbers coming out and there's a little sort of side investment coming in and out that I've made. But for the most part, I look at this step very seriously. And I try to be in companies that are, sort of more floating on cash. I try to have more cash myself, so I'm mirroring those companies. So for example, not being in sort of the major banking system, but being in sort of a PayPal or a Square or something that has the ability to actually join businesses together and sort of be a part of that sort of emerging new way in which the economy can work that isn't necessarily reliant on Fed money. So those are the types of things that, I would personally be investing in. I also do look at infrastructure building. I look at companies like I was just in Mexico, right? I look at companies like Cemex, which is an international cement company, which has, and I'm not, a scientist. I don't really sort of calibrate how cement is created or whatever. They appear to have lots of awards in it, but they also are involved in long-term projects that are funded. And so I look at that. I look at the health of them as a company, and I look at the fact that I think infrastructure is ultimately going to be the way out of either a next crisis or a potential crisis. And I look at those kinds of companies because they have plans for the future. So that's where I look. But I do tend to keep a lot in cash, and I do tend to keep money in things I can use. So like, for example, a home, some place that I can actually live in, or if I need to downsize, I can rent out and actually make some sort of return. So I look at what you can use and what's not leveraged, and keeping at the moment a lot of cash on the side in order to be able to take potential opportunities in either of those kinds of things when we have market dips or market drops, which I see happening more and more over the next couple of years.
Well, thanks a lot for sharing that. I mean, everyone is looking for, that sort of those sort of comments and advice. So I appreciate it and didn't want to put you on the spot. Now, where can people go to learn about you, about, your books, just whatever projects you're involved in? Where's the best place to get information on Nomi Prins?
Well, I mean, you can Google, but I think my website's probably the best place to do that, because I do have my books on there. I do keep articles and media appearances, and also just events, like where I'm going to be in the world. And I encourage people, if they are there, to show up. So it's just my name. So it's NOMIPRINS, nomiprins.com. And I keep that as updated as I can throughout my travels.
Well, Nomi, thanks a lot. And I really encourage people, if you want to understand probably the most important thing to the world economy, and that's banking, you should really follow the works of Nomi, right? That's the foundation you need. Everything else kind of is built on top of that. So Nomi, I really want to thank you for coming on and sharing. And I hope in the future we can ask you to come on again, because I think this reset is going to be unfolding for a number of years. And we'd love to have you on as we kind of chronicle and track the changes.
Thank you so much. I look forward to that.
Okay, take care, Nomi.
You too.